Hello and welcome. It's summerhelping.com here, and we've got a golf course 5-year financial model. Never did it before. I had to do a bit of research to figure out some specifics on this type of uh, model, but it is pretty cool. So, in general, we've got our first page, index page. It goes through each tab name and explains what you're going to find on the tab. We've got some definitions here. And we got some more instructions, and then we go to our first tab, which is the global revenue. And by the way, what I will do here is I'll go through each tab and explain what's going on. And this can be used as a reference when you're actually using the model. And if you have any questions, this should answer them, or at least I'm going to go through every single entry that you'll make. So we got the global assumptions. This is going to be where you put your start date. And remember, no matter what year you're starting, or no matter when you're starting in the year, you have to put the first day of that year. So 1/1 and then whatever year it is. That's important for the integrity of the timing assumptions. So always do that. Um, then we've got a possible exit month, which will be any month within 5 years of this year. And you can also do NA if you don't want an exit. And all this is going to do is it's going to look up the monthly revenue in that month, times it by 12, and get your annualized revenue. And then it's going to give you some multiple of that to give you the actual exit value. So this exit value is basically your percentage times the monthly revenue in this date times 12. And this is going to be important because it flows back through to the cash flow. Next on here is financing, and these are general terms you'd put on a loan, like the amount, term, and years, annual percentage rate, the payments per year, and the month that this starts, because you don't necessarily have to take out the loan rate at the beginning if, for whatever reason, you can do it on it, start it on any month, and that will flow through to the cash flow as well. Then we've got equity required. So this is going to take into account all the cash flows, anything from the business operations, capex, investor funds, financing funds, everything, and then figure out what the minimum cash position is, which means that's the extra cash you, as the company owner or investor, have to make up. Or not the investor, but the company owner. So that's 5.6 million. So that says you either need to provide this, or you're gonna have to get more financing or more investors. So that's what this figure is. And this will flow through once we get to the equity tab. You'll see kind of how all that works if you do have investors. Okay, next up we've got the revenue. So this is the most unique part of the model um, compared to all the other models I do. Is it usually is how the revenue works. So basically, it's pretty difficult because with a golf course, you have to really plan out the user experience. You want to minimize the time it takes to do 18 holes because that's revenue, but you also want to maximize the enjoyment of the course. So you got to balance there. So this kind of goes through a bottoms up way to figure out what your monthly revenue is going to be. We're not doing any membership revenue, but you could technically use this because this is actually doing it based on a round um, utilization of total rounds. So you've got the playable hours per day, the average minutes to play a round, and then based on that, you get your actual total playable minutes in a day, which is 460, and that's just simply multiplying your playable hours per day uh, times 60, so that's your playable minutes per day, and then you subtract your average minutes to play around, and that's because you can't start a round at the very last minute and then go for another 260 minutes. So you have to subtract that final one to actually get an accurate number here. So we've got 460, and these could change each year, but right now I just kept them the same. They might change, so you have the functionality to do that. Then we've got the time between groups. So this is like if one group starts, usually you're going to need about 10 minutes before the next group can start, and that's going to also play a factor in the total rounds that can happen in a day. So obviously, if you have less time between groups, then you can play more rounds. You can have more, facilitate more rounds happening in a given day. So that's another interesting assumption that you can play with. Then you have your actual utilization. So you know you can handle 46, but it's not likely that every single day you're going to have a max amount of the rounds used. So you can do a percentage here, almost like real estate, where you do a occupancy rate. This is kind of like that. So then you get to a final amount of rounds sold here after reducing the total rounds by that number. And so we then go to playable days per month. It might be 25, 26, 30. I just did 30 here. And that gets you to the total rounds that you can actually sell per month, which is just going to be 35 times the 30. Um, then you've got how much you're charging per round, and then the average players per round. And these can change over time. And now, based on all of that, you can finally get to your monthly revenue. So I've made it so it's a nice calculation. All you have to do is enter the cells in yellow and you'll get this number. And it's a pretty accurate way to determine your possible projected revenues. And you can also pick the month that this revenue starts. So, like I said, your first month of the year, you might not be starting. You might be doing construction or building for a while. You might not start all the way until August, or and you can see there that will update if we go to our monthly pro forma here. You can see this won't, if you don't start till August, it's actually will zero out your revenues until then. Now, ancillary revenue is something like, food and beverages or what have you. Could be all kinds of different fees. But that same thing, you could change it. We'll keep it like it is for now. Put this back to January. But your ancillary revenue we've got here, so you basically just do your the golfers per month is based on the assumptions up here. Basically, it's just doing the total, um, just doing the total active rounds you sold per day times the total playable days in a month. So basically, that gets you your 1,050. So you do 1,050 a round, and you do three average of 3 players per round. That gets you to the total amount of golfers that are going to come through your place in a month for year 1, 2, 3, 4, and 5. Then you could do a percentage of that purchases whatever ancillary services. Right now it's just food and beverages, but you could change it. $20. Based on that, you're going to do about 40,000 a month in top line revenue. Then I just put in some simple margins here, like your cost of the um, raw materials, your drink materials and food, and then also your overhead costs, and then based on those percentages, you get some kind of net profit here. And this will flow through to the annual. Basically, the total revenue will flow through, and then the total cost will flow. And that'll all go to, you'll see it'll go to EBITDA. Um, okay, so that's the most important and most complex tab that you'll be working on. The next is just construction and land, so that's simple. You've got, uh, I just did it. You've got 18 holes here. You've got, and I just looked up like the average, the specific amount of types of holes. So we've got, par fours, threes, and fives, and there's a specific breakdown that ends up being a par 72. Um, and then you've got your cost for each hole, so you can break that down. Obviously, different holes could have different costs, but it's going to be some kind of estimation you have to do here. You've also got your land purchase, which could vary greatly depending on where you're buying the land. And then you've got your total construction cost, total land costs, and then the grand total here. Next up is expenses, so pretty straightforward here. For each expense, you can label them. I just did a lot of spaces for you've got G&A, labor, and maintenance. Then I did some marketing and fixed marketing and percentage of revenue marketing. Now, this could also be changed. You don't actually have to keep this marketing. You could change the percentage. So any other costs or any fees or whatever that is a direct percentage of revenue, you could put here. and that would be fine. So the second part of this is you pick the start month. So based on what month, because you might not start everybody all at once. You might be scaling up or whatever the case. So you might start these people in January and then some in March, January, February. See, I have a couple staggered here, but you could have it. These can start at any month, and then they'll just do this as their fixed monthly uh, expense for each one over 5 years. So three components here, the description, the month that expense starts, and the actual amount of that monthly expense over 5 years. So pretty straightforward there. Next we have other costs. So this is going to be your CapEx and startup. So any CapEx is like any one-time purchases that you might do in the future that only happen on 1 month. They don't fix. So it's like if you were to buy new golf carts, um, uh, other new equipment, expansions, course updates. Who knows? You could have a whole bunch of different stuff here. It just allows for flexibility. Then you've got startup costs. So these are costs that happen before month one. So let's say you got to build a clubhouse, you need to get course materials, maybe extra club signage. You got to do the design and architecture, parking lot, golf carts, integration. Now the parking lot might be included in your construction costs. If it is, just make sure you don't double account for it because you don't want it here and on the other tab. So that's all the major assumption tabs that you'll have. Next up, you've got equity. So this is another half assumption, half summary tab. So you've got, let's say you want to raise money from investors. So if you do that, you need to come up with some valuation, um, which is subjective, but you got to figure out what you're going to value the company at. Based on that value and the investment amount, this group will, each entity will get a certain percentage of the company, and then you can also pick the month that they actually fund, so that's a variable. And then based on all of these top, 6 rounds, you might not have them all filled in. You might just have one or two. You'll have remaining equity. This is basically your owner's equity, and this is just going to be the result of subtracting these from one because this always has to add up to 100%. So based on the different valuations and the amounts raised, this percentage will vary. Obviously, these six cannot make up over 100%, or else, well, it means you've actually given away more than you can. Um, so then we can do some cool stuff here. So we've done some uh, IRR calculations, and this is updated now. So this will show you based on an 8% share in the equity and all the cash flows, including the exit cash flow. The IRR for seed one is 15%, and you can do this all the way down. And all this is dynamic and changes as you change assumptions. So then you've got your initial investment of each one, the total return for each one, and then the difference of those divided by the initial investments, the ROI of the whole time, and then you've got your annualized ROI, basically just dividing this by the number of years. It's not a perfect number because if you are an investor midway through a year, then technically you haven't done a full year. Um, so there's some variance there, but that's okay. Then you've got your year of investment here and the per year entity return. So to calculate this summary actually is pretty difficult. I'm actually go with thick bottom here. I'm going to walk through it with you. So you can see we have to keep track of who's got what percentage over time. And so your remaining equity share is going to change as more investors come on. And then you've got the distribution details. So this is the nuts and bolts of how that equity figures are being calculated. So right here we've got the projected after-tax cash flow. So this includes all cash flows, everything. Loans, investor proceeds, business operations, CapEx, loan payback, exit proceeds, everything. So then we've got our initial investment. So here's the tricky thing. If, and then here's going to be the cash flow to each entity, which is just going to do the percentage here times the available cash flow each month. Here's the tricky thing though. If the amount raised is more than this total profit. You can see here the actual sum of the total distributed is only 69,000. That's because 500 of it came from the round two investor. So you don't want to like take in the 500,000 and then give it back out. You only want to distribute the actual positive cash flow outside of the investment, or else it wouldn't make sense. So that's why you see that logic has been accounted for, so we can get a real number of the cash flow to each entity, and that's how we can keep the investment separate from all the other cash flow. And so that goes over the full term, full time. You can see here's the last month we had the exit. And you can see how that's distributed. That's always going to equal the total amount of positive cash flow. Because at the end of the day, all you're trying to do is split whatever cash flow is available among each entity based on their share um, over time. And then we've got, this is our annual equity. So you can see if some investors invest later, they do not, they're obviously not going to get returns in the first year. Now here's the tricky part, is this kind of cash flow analysis, because you have to match up uh, the period. So other 3 and 4 entities invested in the second year, which means you don't, they invested, here's their, well, if we go to our basis for IRR, year zero has to be relatively the same going forward. So for these two investors that invested in the second year, you want their investment to happen in year zero and then their returns to come in right next to them. So we can't have a space here, or else it'll affect the IRR. So we have, and to do it dynamically, we have to set up formulas to make sure it just does this, because technically we could just do an IRR calculation that picks this and then picks some other column, but that's not dynamic. It won't change. So this one will change depending on when the investors invest. And if they were, for example, invested in year 3, then it would just have their investment out in 0, and then it would have the cash flows of 1, 2, and 3. So this is pretty difficult. What's pretty difficult to do, but it's nice because you can do the dynamic summaries on the equity tab, uh, and I think that's pretty useful. We've also got net present value. So based on some discount rate, you've got your discounted cash flow analysis. So this is the total amount returned discounted at this rate. And then you do your net present value, which would be the total of this subtracted from the initial investment of each entity. So some are positive, some are negative here. Just will depend on your assumptions. Okay, that's it for the distribution. We've got executive summary. So this is a high level. You can see main revenue items per year, the total revenue, total expenses, EBITDA, some margins, discounted or debt service coverage ratio. I did a average EBITDA per golfer here. That's an interesting metric. Um, then we've got our other cash flow items: capex, debt service, investor funding, startup costs, exit proceeds, loan payback, and taxes. Then cash flow post-tax and cash position, and the project IRR, which is going to be different than all of these IRRs for specific reasons. They're all based on timing and a whole bunch of different things. All right. So as we move along here, we've got annual revenue and EBITDA in this chart. We've got annual operating expenses in this one with a stacked amount. So you can see kind of what your high level numbers look like. Then we've got a whole slew of visuals here. You see annual revenue by type, revenue percentage, uh, other cash items, total expenses over 5 years, breaking out into what they are. You've got cash flow post-tax each year, EBITDA listing, EBITDA per listing, and that's, you change that to EBITDA per golfer. Then we've got investor and owner cash in and out. So the red is their cash out, and the green is their total returned. So the difference of these two would be their net. Then we've got monthly cash flow versus cumulative. And so this is on an overall aggregate basis each month what the cash flow is, and then the cumulative amount here. You can see it's obviously going up as your cumulative cash flow or your cash flow each month is positive. Then we've got ownership percentage per entity. So this is the equity, this percentage each month per entity in a nice visual. So you can see as more investors come on, the percentage of the owner's equity goes down. Then we've got annual IRR versus annual ROI per entity. And this is, let's see, that's annualized 6 and 5. Let me just look here. Yeah, so that's taking the annualized, not the total. And then finally, we've got the cash flow distributed per entity. So this is, each year where the cash flow is going among all the different investors in the remaining company shares. Then we did a break even. So this is just your variable costs and fixed costs. There's a formula you can use to get what your total revenue break even should be to cover all of that. It's in chart form here. Then this is the monthly pro forma. So this is what is going to drive the annual pro forma, which then drives the executive summary and a lot of other things. So this is where this looks at the assumption tabs and the revenues, expenses, and everything else, and it populates over the course of 60 months. And you can see all the items here come flow through dynamically. The only manual entry here is taxes because that could be pretty tricky. So I just did it so you can have a place to enter it if you need to. See, if you enter it there, it subtracts off your cash flow. Um, and you can see the dynamic, everything coming in the right month. Loan proceeds, it's assumed when you exit that you have to pay back whatever the loan amount, the loan balance is at that time. It knows how much principal you've paid off based on the debt detail tab we've got. Um, there's the exit proceed coming in. Then this annual pro forma is the same exact thing as the monthly. It's just an annual basis. And then what you can do is I've done up here, you can do click between 1 and 2, and you can see if I did 1, it hides all of these groups. So you can just see the high level um, amounts rather than, scrolling through everything. So you can do that for each, the monthly and the annual. I'll just expand it for now. Then we've got our debt amortization schedule. So this is just what I just was talking about with the loan balance. So this is what's used based on what you enter in the global assumptions tab for your financing, and that's going to flow back through to the pro formas and the cash flow. Then I did some notes and references. You could see different places to look about starting a golf course and what things you need to be thinking about. All right, that's it. So if you actually want to get this financial model, you can just click through the link below, or if you're on one of the vendors that I post on, you could buy it right there from them, and you'll get the template directly. I haven't decided on the price yet, but you'll see what it is. It may change over time. All right, have a great week, and I'll see you on the next one.